Did the did the recent mortgage interest rates drop change your real estate portfolio? Well, that is what we are talking about today in this episode of the Never Lose a Deal podcast. My name is Lorillia Brown-Phillips and I am your host. And today we are going to talk about the interest rate drop that happened about a few weeks ago. Now, I know I may be late on this topic. I know it may be old news for some, but let's kind of talk about it because there are things that many real estate investors may be considering since the interest rates have dropped. And the reason why I say that is because of many of the lenders that I work with in the space of asset based lending, commercial lending, primarily for DSCR loans and other types of mortgage financing. Currently, the rates are at 5.5% for investors. Now, of course, I'm only talking about investor financing. I'm not talking about FHA or any other conventional type of investing. So anything that I talk about today is going to solely be regarding investor financing. So before I get into the topic at hand, I always want to introduce myself. As I mentioned to you, my name is Lorillia, and this podcast is primarily for real estate investors who want to find creative ways to be able to expand and scale their real estate portfolio, which is why I thought today's topic would be good to talk about. Because does it really matter? Does the change in the interest rate market really determines if you are getting back in the game? Did you stand on the sidelines and wait, or are you actively investing? And so I kind of want to talk about that because this is what I'm seeing. I am seeing, and I talked about it in my last episode where I talked about doing a debt stress test on your real estate portfolio. Many of the investors that I work with, nothing has changed in terms of them actively pursuing still investing in real estate, even when the interest rates were above 6%, close to 7. I saw many investors who were still investing and who were still looking for financing. And so the interest rates don't really matter for some investors. And that is what I want to talk about today because I've had investors who've come to me, and many of them are usually newer investors, but they want to get to that space where they can feel comfortable with expanding their portfolio. And it all boils down to having that confidence, comes down to being able to run your own numbers on your portfolio. And that is why I did the last episode, and I talked about doing a debt stress test on your portfolio because many investors, when you get to the point where you're buying three or more properties and you've gone beyond four properties and they're multifamilies or what have you, many of those investors are not buying in appreciation. You will find that that whole conversation of appreciation and house hacking, it really lends itself to newer investors. Now, don't get me wrong, can you build a wealthy portfolio, real estate portfolio doing house hacking? Yes, you can. But many of the investors that I talk to and that I do business with, they are past the house hacking stage. And usually, house hacking is you buy an investment property, it could be a multi, it could be a duplex, and you live in one and you rent the other one. And a lot of times, the financing that you get is determined by your financial standard. I mean, by your financial status. So the mortgage lender is going to look at you as the person getting the loan. So they're going to look at your financials. They're going to look and see, can you afford it? They're going to look at your income, and they're going to look at your debt to income ratio. As opposed to when it comes to the investor side, now the underwriting and the financing is based on the asset. So when I talk about, does the interest rate drop really control or has any influence on your real estate investing strategy? Many of the seasoned real estate investors know that any underwriting is going to be based on that asset. So if they have a interest rate that's 5% or 6% or close to 7, but they're still being able to cash flow, they're still being able to have the return on investment that they want, or maybe they have something better in stake. They can be looking to invest in a particular asset to lower their tax liability. The list goes on and on. But when they're getting that financing, the financing is based on the asset. So what happens is the lender is going to look at, okay, does the asset generate any cash flow? Is the asset bringing in revenue? Or if you are going to be buying something and you're looking to maybe raise the rent or add in new tenants, are you going to raise the value of the asset? Is that going to increase rents? And then what are the expenses of the asset that you are looking to buy? Once again, the debt to income ratio is based on the asset, what is being purchased by the investor. That's totally different from the conventional way of buying a house or buying a house with a FHA loan or what have you, where that whole house hacking strategy. So take into account that if a investor is buying real estate and they know that my numbers are where I need for them to be, meaning that I'm not high, I'm not over leveraged with buying this asset, even if my interest rate is in the fives or my interest rate is close to 7, I'm still able to cash flow. I'm still getting the tax benefits that I want to get. I may be even saving for retirement. The goals of what is the the goals of what that real estate investor wants is based on the goal of the investor. So interest rates don't really matter. And that is why many investors who desire to get into a space, of course, as always, as soon as I do a podcast episode, I get all these alerts. Um, ding, 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 ding. Let me put my phone on airport mode because, of course, as soon as I get on this podcast, everything alerts. But as I was saying, the goals of the investor is determined by what he or she wants. So interest rates don't really matter because the only time interest rates come up in a conversation is normally an investor who is not um I would say, I don't want to say seasoned, but they haven't got to the point where they're comfortable with doing the underwriting on their own real estate deal. And you being able to do your underwriting and not waiting for a lender to do the underwriting for you puts you in the seat of having control. That's why that episode that I did a few weeks ago, where I talked about in this current environment with a lot of the volatility that is going on, you having the ability to be able to know if you're over leveraged in some areas, or if you are looking to balance out your portfolio. Because even with interest rates now that they've gotten lower, many investors are looking to do that. Many investors are looking to refinance because they may have bought a property a year ago where the interest rates were in the sevens. And so now, with interest rates being lower, like I said, many of the lenders that I work with, in the asset-based lending space and the commercial lending space, the rates have been lowered. And I know I have been reaching out to some of my clients or investors that I spoke to in the past and letting them know, hey, interest rates have gotten lower. Are you considering um, doing a refinance on your portfolio? Maybe you do want to be able to look now and maybe look at your portfolio. Definitely do a debt stress test and see, oh, are you over leveraged? Or what are your goals in the future, that would that you would like to pursue? And maybe a refinance will assist you with maybe pulling some equity out or just lowering your interest rate so you can get more cash flow into your portfolio. Those are a lot of things to consider when the interest rate has been lowered. So those are things to consider if you are that person that's saying, yes, interest rates are lower, but now what? As I mentioned, are you looking to do a refinance because maybe you want to pull some equity out to invest in other things that you have in mind? Because if your goal is to expand your portfolio or scale your portfolio, you may want to pull some equity out of your investments, or maybe you want to do a refinance so you could get a lower payment. And so now, when you run the numbers, that will allow you to have more cash flow coming into your portfolio. Those are just two of the things to consider. But interest rates for some investors do matter because, once again, the goal of that investor can be different. And that is what I tell investors all the time. Your goals are your goals. And so, whatever those goals may be, however they may impact you, are those goals for retirement? Are those goals, for your family? Is it for you to pass down to maybe some of the heirs or your family members? Is it something that you want to be able to hold on to for a couple of years so you can move on to bigger investment plays that you have in mind? These are all the things to consider when interest rates are lower, because maybe that was your plan. Maybe your plan was, I'm looking to take on bigger types of acquisitions, but I need my interest rate to be a certain place because when I ran the numbers, you did your own underwriting. You're not waiting for a lender or a broker to do your underwriting for you yourself. And now you see that, okay, if my interest rate is in about this ballpark, this will allow me to move to a whole different asset class that I can add to my portfolio. So these are some of the things to consider. Now, as we approach the fourth quarter, as I film this podcast episode, it is currently September 2024, 2025. I mean, oh, I'm a whole year behind 2025. And we are going into the fourth quarter, the final hurrah. This is the time where many investors will now have those conversations with their accountants, with their financial advisors, to decide on what are the plans going into 2026 as well as 2025. But this is also the time that many investors are talking to financial specialists like myself, funding specialists, financing specialists in the real estate area, to discuss and talk about what's next. Let me give you a real life example. Prospect of mine that I have been working with shared with me that they are looking to buy a package of assets, possibly 3 to 5 properties, and they roughly are looking at possibly close to $500,000, 500, or it's going to range between 500 to 600,000, these package of assets. Currently, this particular client is looking to negotiate with the seller with these assets because the seller is selling them without an agent. And so they want to know what is the best financing for this particular acquisition. These are the conversations that I have with clients or prospects because your mortgage financing matters. The wrong financing advice could possibly hurt you because when you decide to take on bigger opportunities when it comes to real estate, it is just bigger than just the interest rate. This particular client wanted to know what was the best possible financing to be able to buy um, 4 properties in this particular package. And these are the things that me and this client is working on because some of the properties are going to need work. Some of them, all of them currently do have tenants in them, but they're not in the best condition. So we're looking at what is the best financing to be able to acquire this package. Why is this conversation important? Because just like I mentioned, fourth quarter planning. Same way you have your conversation and your meeting with your accountant or your financial advisor or maybe your attorney. This is also the time to have a conversation with a professional similar to myself, financing professional, funding specialist who specializes in um, financing for real estate professionals. This is the time to have those conversations, especially if you want to close out the year to lower your tax liability. And that is something that this particular client is looking to do. They are looking to lower their tax liability as well as grow their portfolio of real estate assets, um, and they aggressively want to be able to do this. They don't have no plans on leaving their particular job because they enjoy what it is that they do. So they don't desire to be a full time real estate investor. What they desire is to have a portfolio of assets that can cash flow and that can carry them as they go into retirement because they know they have a particular time horizon, and that time horizon while they're working they have so many working years that are ahead of them, and so they want to aggressively be able to build out this portfolio and making sure they have the right financing to make this happen. So in this case, as I mentioned earlier in this episode about why interest rates doesn't matter, because for this particular client, they are not focused on the interest rates. As long as, once again, going back into what are your goals, this particular client is very clear on as long as these benchmarks are being met. The ability to build out and scale my portfolio, that particular client wants to be able to do that because they want to aggressively do this because they know they're going to retire in so many years. They are concerned about, lowering their tax liability because they understand they're a working professional that makes, well over, um, six figures, and so they want to lower their tax liability. So they like the tax liability piece of owning real estate and having a portfolio. And so those are the desires that this particular investor wants. So they're not concerned about interest rates as long as, and then I forgot cash flow, and if these particular assets will cash flow. And so that's their concern. So when a person says interest rates don't matter, many people look at these investors and they're like, well, what do they mean interest rates don't matter? Because, you know, we can't predict the future. All we know is that we are not in an interest rate environment like we were in 2020 when interest rates were at 3%, 2%, or what have you. And so sitting on the sideline with the hopes of, I hope the 2%, 3% interest rates come back, is really, it's a child's play game. And a lot of times those conversations primarily come from people who are desiring to get into real estate, but they haven't quite gotten started yet. So they are only able to make decisions based on what they saw previously. But seasoned investors and experienced investors know that these are the goals that I have in place. And as long as these goals are being met, um, they are happy. And so interest rates do not matter. So everybody, has a different goal. There's 100 ways to skin a cat, like I always say. So there's no right and wrong way of doing it. That's why I titled and I started this podcast episode with saying, um, interest rates are lower. Does it matter? Does it matter for your real estate portfolio? Because it may matter to you, but it may not matter to someone else. So, as always, if you are a real estate investor and you want to talk about a particular uh, loan scenario that you would like to discuss, you want to know what's the best financing that you would like to know that would work for your future plans. If you look at the ticker that's going across the screen, you can go to www.leverageportfoliocapital.com. But if you are somebody who just wants to know what's possible, what does it look like for a real estate investor to be able to leverage creative financing, I welcome you to join me on my next month's webinar, how to leverage 0% business credit cards and creative financing to expand your real estate portfolio. You can learn more about it if you go to www.neverloseadeal.com. All the information will be in the show notes. And that is for if you want to know what does it look like. I'll be doing a free webinar in October to give you an idea of what is possible. So you can learn more about that webinar as well. Everything will be in the show notes. As always, if you're watching this on YouTube, leave me a comment. Let me know what are your thoughts. And if you are listening or watching on one of the podcasting platforms, I would love to hear your thoughts. Please rate it. Leave me a rating and let me know what you think of the podcast. As always, this